Welcome to episode 4 of this e-learning series. In this episode, we'll explore how to match investment needs with appropriate financing options. As you may recall from the previous episode, we invest in disaster risk reduction for two main reasons: preventing and mitigating disaster impacts, and ensuring the financial resilience of public and private actors. This distinction matters because the financing options differ depending on the objective.
Let's start by looking at the modalities for financing investments in prevention and mitigation. The first modality is policy reform. Policy reforms don't provide finance by themselves, but they can steer financing toward disaster risk reduction. For example, governments can make infrastructure investments more resilient by enforcing robust building codes. They can also push companies to take disaster risk more seriously by requiring them to disclose these risks in their annual reports.
The second modality is budget allocation. Public budgets are central to financing resilience measures, but they are constrained. Even so, budget relocation is possible, especially when backed by strong evidence that resilience pays off. Some governments ring-fence resources or create dedicated funds to safeguard financing for this priority. Others adjust their budget processes, so ministries must specify their planned spending on disaster risk reduction. This helps ensure the priority is reflected across budget submissions.
The third modality is borrowing. Borrowing is suitable for high upfront cost investments in resilience. Countries have different borrowing options. Development banks offer concessional loans, though supply is limited and typically tied to specific requirements. Commercial banks, which are faster to mobilize but often have shorter terms and higher costs. Capital markets, including newer instruments such as resilience bonds. But no matter the source, borrowing has limits. Countries must keep debt within sustainable levels.
A fourth modality is creating new revenue streams. These revenues should come from those who directly benefit from resilience investments. For example, public authorities might collect taxes on real estate protected by flood defenses. Water companies may pay landowners to maintain wetlands that protect water quality, a model known as payment for ecosystem services. However, monetizing resilience benefits can be challenging. Deciding who pays and how payments are collected can be complex.
The fifth modality focuses on mobilizing private investment. Much of the financing for resilience must ultimately come from individuals and businesses. Governments can encourage this through financial incentives, such as tax credits for retrofitting buildings or subsidies that reduce insurance premiums for businesses adopting resilient practices. They can also promote business models like ecotourism that support resilience goals. Engaging local banks is key as well. Public guarantees, for instance, can help banks lend to farmers who want to transition to more resilient crops.
The sixth modality is donor funding. Donor funding is essential when public finances are constrained, especially in vulnerable economies. But because donor resources are limited, they need to be used strategically, supporting high-impact actions, capacity building, and innovative mechanisms like blended finance that combine grants with debt instruments. Countries should also take advantage of climate financing opportunities, including the Green Climate Fund, and build the capacity needed to access these resources.
While we have discussed each modality separately, governments often need to combine several of them to finance disaster risk reduction. For example, investing in resilient housing may require policy reforms to upgrade building standards, budget allocations to fund targeted subsidies, and loans to support construction of social housing.
Now, let's move to the second type of investment, those that strengthen the financial resilience of public and private actors. Governments can use a risk layering approach. One set of instruments for frequent, lower-impact disasters, and another for real but severe events. The first set covers risk retention instruments, which governments use to manage disaster costs internally, rather than relying on insurance or humanitarian aid. One such instrument is a disaster fund, a budget set aside specifically for disaster response. These funds are readily available and allow rapid response. The downside is that money tied up in the disaster fund cannot be used for other development needs. This makes sizing the fund carefully essential.
Governments can also rely on budget reallocation, sifting funds from other programs. However, this often requires multiple approvals, can be slow, and usually limited in scale. Another option is a supplementary budget outside the regular cycle, though this too may cause delays. Another risk retention tool is adaptive social protection, which uses existing safety nets to quickly scale up cash transfers or food assistance in response to a disaster. These systems can be triggered by a predefined indicator such as a disaster declaration or an early warning signal, enabling both rapid response and anticipatory action.
Next are contingent credit lines. These are pre-arranged credit facilities that become available once a trigger is met. Many development banks offer them, allowing countries to avoid negotiating loans during a crisis. They often come with a policy or institutional reform requirement. Some banks also allow countries to repurpose undisbursed financing during emergencies. Finally, climate-resilient debt clauses allow countries to temporarily pause debt repayments after a disaster, freeing up fiscal space. Importantly, no debt is forgiven. The payments are simply deferred.
The second category of instruments involves risk transfer solutions, designed to protect against less frequent but more severe disasters. Governments can use sovereign parametric insurance, which pays out when a hazard exceeds a predefined trigger, such as wind speed or rainfall amount. But calibrating those triggers is crucial, because if events fall even slightly short of the thresholds, no payment will be made despite substantial damage. To improve affordability and accessibility, several regional risk pools have been established, including the Caribbean Catastrophe Risk Insurance Facility, the CCRIF, and the African Risk Capacity, the ARC. These mechanisms allow countries to share risk and reduce insurance premiums.
Catastrophe bonds, or CAT bonds, are another option. They function like traditional bonds. The issuer pays interest to investors. However, if a predefined disaster occurs during the bond's term, part of the debt is forgiven. Because investors assume this risk, CAT bonds tend to have higher interest rates and short maturity, typically 3 to 5 years. Governments can also protect public finances by insuring their own assets, such as government buildings. In some countries, regulations require local authorities to insure all public assets.
The level of insurance coverage in the private sector also affects governments, as they are often called on support households and business after a disaster. Unfortunately, insurance coverage in many developing countries remains low. One way to expand access is through community risk pools, where groups such as farmer associations combine their risks to secure more affordable insurance.
International initiatives also help close the protection gap by expanding access to affordable insurance products in vulnerable countries. With this, we conclude this episode where we explored a wide range of modalities and financial instruments for managing disaster risks. In the next episode, we'll look at how countries can combine these options into a coherent financing strategy. Thanks for watching, and see you in the next module.